Hello, my name is Junganelli, and today we are going to be joining a Zoom class. So make sure you subscribe to the channel.
Okay, I guess we can start. This lecture is the last lecture that we have for this topic, and we've basically looked at audit planning and risk management. We've looked at some of the audit procedures that we undertake and looked at the evidence. And all this is a brief of what you're going to cover in the next topics, because I think topic 5, you will do audit of financial statements. Then topic 6, you will do audit review and reporting. Okay. So now here is just to give you an introduction of what you will meet, and because all this has to be done during the budgeting phase, okay, rather during the planning phase. Edwin Okalang, Edwin, please mute your mic. Thank you. So basically, when you do an audit plan and you come up with the overall strategy of how basically you're going to conduct your audit, looking at the scope, the timing, the direction of the audit, you are basically coming up with what you call an audit planning memorandum. Okay, and it has these things, and I know we have looked at them. When the main areas are like characteristics of the audit, we've looked at. Now here the matters you're looking at, we've looked at things like the financial reporting framework. Do these guys report using IFRSs? The industry specific reporting requirements. For example, in insurance, we have a specific reporting requirement of IFRS 17, and in the banks, you're supposed to report to your regulator. Even in insurance, you report to your regulator. Then expected coverage of the audit, that is basically like 1 year. The nature of the business segments to be audited, and any need for specialized knowledge. That is why you don't have the necessary expertise. Are you going to rely on the work of the internal auditors? Yeah, are you using service organizations like technological firms? You know, then the reporting objectives, the entity's timetable for reporting. When do they report to the audit committee? When do they report to the main board? And then eventually, when are they supposed to report to the regulator? Then you're also supposed to look at organizing meetings, because like I told you, you'll have a series of meetings between the audit firm and management. For example, with management, you will have what you call an opening meeting, like taking management through what you're going to do, your expectations from them, any changes in IFRSs, what they have done. Also, those charged with governance, like I told you, the audit committee and the main board. Yeah, discussions with management when you're going to have them. We normally have quite a number of discussions on findings, discussions of the status of the audit, and then the audit committee also. Unexpected communications with the third parties like banks, lawyers, debtors, creditors, the regulators in case there is need. Then another area you look at is significant factors and developments. There are some things that may have come up within the industry. The industry keeps on changing regulations, things that have come up within the business, like the emergence of COVID, any changes in the reporting framework, like the introduction of IFRS 9, IFRS 16 in 2019 and 2020, the understanding of the internal control system, your understanding of the high risk areas that are more vulnerable to misstatements, what the auditors the volume of the transactions, because then that will help you come up with your materiality. You come up with your sample. What are you going to look at? What are you going to leave out? Yeah, any significant recent developments, like for example, if there is retirement of the chief finance officer and then the chief accountant at the same time, what kind of risk does it pose? If there's a new chief accountant, new CFO, that poses a risk in how the audit is going to be run, because these guys are still probably learning, okay? Learning the systems of the business. So the nature, timing, and extent of resources. Here you're looking at the audit team, selection of the team that you're going to use, or what we call an engagement team. Then you assign the work to the team members based on their level of seniority, putting into consideration independence issues. How many seniors are you going to have on the audit team? How much are you going to? They are what we call out of pocket expenses. You learn more about them, like how much is it? How much are we going to use? Are these people? Because most of them will have to move from the audit offices to the client's offices. How much you're going to use the engagement budget? Yeah. So you look at all these things as you're coming up with your overall audit strategy, because it shows you, okay, are we, since it's far, are we going to work remotely? Are we going to ask the client to send us the supporting documentation in soft copy? But at one point, shall we have to visit the farm, probably to do a walkthrough of the IT system? Are we going to probably visit some of the branches for stock taking purposes? Are we going to attend a cash count? Are we going to attend a cash payout? All those will define your audit strategy. But I want us to look at this example. Yeah, this example shows you. Let me stop sharing so that I eliminate what someone did. Okay, are we ready? Can we look at this example? You are an audit manager in charge of the audit of Templar Limited. The company's year end is 31st December. It is always very important to note the year end of the company you're auditing, because then it defines the timelines. Okay, you must be very careful with the timelines. As you're noting the year end, you also note when the audit committee of the board sits, and when the main board sits, and when the annual general meeting is there. Okay. Then you also have to note the reporting deadlines of the particular industry. For example, banks and insurance companies, our reporting deadline is 31st March. So by 31st March, we must have submitted these accounts to the regulators. The regulator for the banks is Bank of Uganda. The regulator for insurance companies is the Insurance Regulatory Authority. Okay. So that is very key. The year end, the regulatory period, the regulatory reporting period, the timing, meeting timings for the audit committee, where the company has an audit committee, then the timing for the main board meeting, then also the annual general meeting. Okay. Can you all see what I'm sharing? Yeah, there's someone. Bonita is not seeing what I'm sharing. Okay. So so the company is basically in the business of purchasing and reselling trucks. It is also very important for you to appreciate the nature of business your client is engaged in, because then that gives you an understanding on whether you will need specialists or experts. Okay. Because you may not be in a position to revalue trucks. Now, for this company, the tractors are the inventory of this business, because they are in the business of buying and selling trucks. So you may not have the capacity to revalue or to determine the realizable value of these tractors, because according to IS2, you will have to look at, you will have to be very keen to ascertain whether the company is valuing assets, their inventory at the lower of cost or net realizable value. Okay. So such things are very crucial for you to appreciate as an auditor, because they give you more information, like what is the scope of the audit. You know, the scope of the audit, if the year ends on 31st December 2021, that implies that it starts on 1st of January 2021 to 31st of December 2021, unless otherwise. That means that the scope is going to be for 12 months. Okay. And also key to note is that Templar has been a client for 7 years. You know, that creates some independence issues. You know, when you audit a client for a long period of time, it creates some familiarity threats. Okay. For example, in some entities, in some crucial industries, for example, I'll again use our industry, insurance and banking, financial institutions. You can't audit a client of a period more than 4 years. Yeah, you audit 4 years, then they are required to rotate. For example, if the first 4 years they did KPMG, then the second they can't do KPMG. They will either do PwC, Ernst and Young, Deloitte and Touche. And by the way, maybe for your learning purposes, for certain industries, for example, financial institutions, they define specific audit firms that are supposed to audit those companies regulated by them. For example, you find that in the insurance industry, you'll be audited by KPMG, Ernst and Young, Deloitte and Touche, PwC, you know, those, I think Grathon and something, you know. So they kind of define. So you don't just go get any audit firm that you feel you want. You can do that for internal audit, but they also specified. Okay. So the following is information on the company's financial performance. Here, when they give you, yeah, yes, the first audit firm. Yes, yes, you are. The regulations, now, for example, the regulations of the insurance regulatory authority governing the insurance companies says that you can, an audit firm or as an insurance company, you can't have the same audit firm for a period more than 4 years. So, for example, if you did KPMG from 2018, 2019, 2020, 2021, right? You can't use them for 2022. You can do now 2022, you will do, let's say, PwC, right? But then after the 4 years of PwC, let's say 2022, 2023, 24, 25, you can even go back to KPMG. You get what I'm saying? Yeah, so it is, they can't be more than 4 years consecutive, but then you can do now another one, then you go back to it, the other. Okay. Yeah. And then I was explaining to you why it is crucial to look at the forecast. A forecast is like what you expect, you know, and like after you've started the year, and the actual, it gives you the fluctuations, you know, the movements. This is now applying your analytical procedures. You know, you look at the growth in revenue or the dip in revenue. For example, the forecast was 4.5 billion, but they did 4.4 billion. Okay. You see the cost of sales 3.7 billion. The actual was 3.8 billion gross profit. But then you look at the drop in revenue vis-a-vis the drop in cost of sales. You know, ideally, the drop in revenue should be the same as the drop in cost of sales. If it isn't, then given that this company is a heavy inventory company, there's a possibility that either the inventory was overstated or understated. You know, it depends. For example, why would it be that the revenue has gone down, but the net profit is high compared to, okay, you have a revenue of 4.5 billion forecasted 4.5 billion, but you forecast a profit of 43.6 million, okay? But when you see the revenue has reduced, but the profit is more than the forecasted, that is an indication that probably within the cost of sales, the inventory is understated. And if it's understated, it leads to an increase in the net profit. Because when you understate, because when you look at the distribution costs, they're in check. You look at the administrative costs, they're in check. But when you look at the cost of sales, the dip is so big compared to the fall in revenue. I don't know whether you get what I'm saying. So it is an indication that either the revenue, either inventory is understated and hence having a higher net profit, but we shall see the solution. So here you are applying analytical procedures. This can show you things to do with the high risk areas. Here inventory will be high risky, there's a possibility of misstatement, either overstatement or understatement. Okay, and there's a possibility of whether they are following IS2 or they are not following it. Then there's also this other information. You can see the net. There's a drop. There's an increase in the non-current assets. The forecast was 360, but they closed at 450. You can see the receivables are reducing as well, but though when you look at the receivables of 600 vis-a-vis the sales of 4.5, it kind of looks big. You can see the cash is high. Now, when you look at the cash dropping, rather the receivables dropping and the cash increasing, that means that probably there's collection. But when you see inventory is increasing, that means that there's probably slow moving inventory, okay? Because ideally forecasted at 20, then it becomes 127. That is a big jump of 107 million.
Would you come again on that analysis, sir?
The one of which one? Hello? Hello?
Hello? Yes, sir.
Yeah, which analysis, Moses?
The one
Is
of
this Moses?
Yes, sir. The one on inventories.
Yeah, now the one of inventory, you see, if you forecasted your inventory to be 20 million at the close of the year, yeah, but it ends up being 127, that means that either the sales are not as planned or you have slow moving inventory. Are you getting it? Or you are overstating your inventory. So it can be either of the two until maybe you have some additional information backing it up. It can be either of the three. Either the revenues are not as you anticipated, which is understandable because at 4.5 billion, you had considered having a inventory worth 20 million. But because you didn't meet your revenue, that means that you're keeping a lot in inventory, like your revenue is down, your revenue is down and your inventory is high. Okay? Are you getting it?
Yes, sir. And there is where you said you talked of a collection, that there must have been a collection.
A collection in receivables.
Yes.
Yeah, you see now here, the receivables were 600, forecasted at 600, but then they happen to be 405, right? So here you do what you call receivable days, For example, if you had forecasted to make a sale of 4.5 billion with receivables of 600 million, but you end up selling 4 billion with receivables of 405 million, it is an indication that you're selling a lot on credit, right? Because when you look at the drop in receivables is only around what? 195. Let's say 195. 600 minus 405. But when you look at the drop in revenue, it is quite significant. So you have to compare, because revenue, debtors come from sales, right? So the more you sell on credit, the more you have debtors. Okay. Another thing is that your share capital is not changing. Your retained earnings, of course, will grow because you have more profits. Your non-current liabilities have increased. Yeah. When your non-current liabilities increased, guys, you look at this. Your non-current liabilities were forecasted at 100,000. They ended up being 105. What does it mean? You see here, there was an increase in risk in assets. Yeah. Where probably they borrowed money to buy more assets, because the assets increased by 19 million shillings. Your non-current assets are increasing by around 105 million shillings. That means that they probably borrowed to buy more of the assets. Okay. The current liabilities are high at 300, and they have reduced from 300 to 259. Yeah. Maybe they should have increased a little bit more, because then these guys are holding a lot of cash. You know, they're holding 159, yet they have current liabilities of 259. In practice, ideally, you ask these creditors to give you discounts, and then you part with this money, because it doesn't make sense for you to hold money yet you have creditors. So you use the advantage of having money to ask these creditors to give you discounts, and then you make payment. But then numbers alone are not enough. You always have to look at additional information. It is said the industry that Templar trades in has seen a moderate growth.
You didn't conclude on this third last of non-current liabilities.
Yes, I was saying that, you see, the non-current liabilities were forecasted at 100,000, right? But they ended up being 205, rather 100 million, but they ended up being 205 million. Now, I'm asking that, why would they get? Are they cash strapped? You know, always people, when people go into debt, the indication is that they don't have money to pay. Are we together? So now you look at it and you're like, okay, maybe they got money to finance an acquisition of an asset. And here, when you look at the assets, they're growing from 360 to 450, roughly 90 million shillings. So someone can argue, before looking at additional information, that yes, they borrowed money probably to acquire a non-current asset. Is that okay, sir?
Very well, sir. Thank you.
But then, like I said, that it's very important to look at additional information, or that information. Now, this additional information, you will gather it from the industry statistics, from the representations by management, because you have to sit with management to understand how their business is operating. For example, here, other information that you gathered, the industry that Templar trades in has seen a moderate growth of 7% over the last year. So if they are growing by 7%, now you look at how did these guys perform, you know? Then we see non-current assets mainly relate to company premises for storing inventory. 2 delivery vans are owned with a net book value of 100,000. 2 delivery vans are owned with a net book value of 100,000. Yes, we shall see what that means. Okay. But you can see that they must have set up some premises because of an increase. One of the directors purchased one of the company's old vehicles. Can someone tell me a risk there? When one of the directors purchases one of the company's old motor vehicles, is there a risk that you can think of?
Yes, it is there.
Tell me, what risk can you think of?
I think he can buy the motor vehicle at a lower at a lower
Self-interest.
NBV, something like
Yeah.
that. At a lower
So
NBV.
it is to do with related parties where the transaction may not be at arm's length, right? These guys may have sold to themselves the motor vehicle at a lower cost. So you have to look at the process that they went through in selling the motor vehicle to the director. Was it an open bid? Did they auction these motor vehicles? Stuff like that. Inventory is stored in 5 different locations across the country. There's a risk as well. When inventory is so dispersed, there's a risk that probably the stock take may not be done because these guys may not probably move to all those places. With the farm having offices close to 2 of those locations. So meaning for you have your office is close to 2 of those locations. So meaning that 2 out of 5, meaning 3 of those locations are kind of a distance. Yeah, because they are saying that the farm is close to 2 of those locations, meaning that the 3 are a distance from the farm, from the audit farm. That implies that you have to budget as how you're going to do the stock, how you will attend the stock take. A computerized system was introduced in August 2021. That means it was introduced midway in the year. The inventory balances are now obtainable directly from the computer system. The client does not intend to count inventory at the year end, but rely instead on the computerized system. Now, where figures are migrated from a manual system to the inventory system, there's a possibility of either overstating or understating. There is that risk. Anyway, you're required, using the information provided above, prepare an audit strategy for Templar for the year ended 31st December 2021. So we're going to look at this together. So like I said that, yes?
Can a risk of omission and commission apply?
Yes, very much so. That is why there will be either when you omit, you are understating your inventory. When you commit, you are overstating your inventory. Thank you very much. So like I said that everything you do in audit must have a working paper. So this one is a working paper in respect to audit strategy. You give it a working paper. WP is working paper reference. Yeah, you can probably say 001. The client is Templar Limited, prepared by the audit manager. Normally the audit strategy is prepared by the audit manager. You give the date of preparing the audit strategy. The year end 31st December 2021. It has to be reviewed by someone senior to the audit manager, who is the reporting partner. Okay. So now we look at the engagement team. Because in the audit strategy, you have to look at your engagement team. So here we say we are including specialists. Why? Because basically we say the engagement team should be based on looking at the knowledge of your people, the people you have, and the skills they have. So if they have the necessary skills to detect material misstatements, okay? So all your audit team should confirm, the audit member should confirm that they don't have any independence issues. For this company, since you've been auditing it for the past 7 years, there's a very high possibility that independence is impaired. Auditing an audit firm for 7 years, you might find that some of the the team members are dating accountants there, because they have been there for some time. But it is always advisable that you keep rotating your team. If today you've taken Moses and Jennifer and Michael and Mansoor, the other time you can twist. Okay, you can do a little tweaking here and there. You change these people so that they don't become so familiar with these members. Okay, so now you indicate the name of the members that you are taking, their roles, what they are going to look at, their qualifications, the experience of the audit partner, the associate, the director, the managers, then the audit senior, audit assistants, who they call associates, okay? Then also, if you realize that it's important to have an expert, you bring them on what? You bring them on the team, okay? So basically, you're laying out your audit team or your engagement team, okay? Then the scope of the engagement is per the engagement letter. I know you studied about an engagement letter. That's a contract between an audit firm and an audit client. It stems out what the scope of the audit is. You're going to audit financial statements for this period, okay? Then in your own audit strategy, again, you have to understand, like I said, the characteristics of the audit. Yeah, is it a statutory audit? Is it a non-statutory audit for this case? It is a normal statutory audit because this is a company, okay? There are no audit or reporting exemptions available, yeah, based on the client. The client uses international financial reporting standards, IFRSs, and there's no industry-specific reporting requirements, as in they don't have a specific date of reporting these accounts to the regulator, meaning that you may not be so much into a hurry. Are we together? Compared to where you're auditing a bank or an insurance industry, an insurance company. So those are the characteristics of the audit. So this audit may not be so much time bad, okay? Then you also, in your audit strategy, you look at the key dates in the audit timetable. When are you going to do your interim audit? Like I said, normally the interim audit is done in October, covering the previous 9 months, which is Jan to September. Then the final audit, normally final audit happens after the year end, normally around January. For example, if you're auditing 2021, you do January 2022. You start around January or February 2022. Then when are you meeting the audit committee? For example, in our case, where we report to the regulator on 31st of March 2022, our audit, the auditors met the audit committee on 15th of March. Then they met the board. Then the audit committee discusses the accounts and they recommend them for approval with the main board. Okay. Then financial statements are approved. When are they approved? Normally before 31st of March. I'm giving a practical example of our company. Then the specific dates are to be confirmed. Now, when you are doing this audit strategy, you don't know the specific dates. Because, for example, you may not know when the audit committee is going to sit. But normally, for example, in our case, we always have the audit, we always have the board timelines. We know when the audit committee is going to sit. We know when the main board is going to sit. So here, the issue of specific dates being communicated or confirmed is not, they're definite because we know them and we communicate them to the auditors. Okay. Then what do you understand about your client? This is very key. Templar buys and sells tractors. I told you about that. The company has 5 stores, 2 of which are located near your offices. What does that mean? It means that you may have challenges visiting the other 3. Okay. The industry that Templar is operating in has grown by 7%. Templar's revenue increased by 12%, indicating that the company has performed above the industry average. Okay, that is very crucial. Now, had it been that the industry has grown by 7%, but Templar's revenue drops by 10%, then there is a significant risk, with Templar. Okay. Helen, interim audit, like I think we covered interim audit on Friday. Interim audits are audits that are done to cover the initial part. They are done to reduce on the workload, of the final audit. For example, in our case, allow me to use a practical example. In our case, our accounting period starts on 1st of January let me say 2021 to 31st of December 2021. Okay, so the interim audit, our interim audit is done in October 2021. It was done in October 2021. It covered a period from 1st of Jan to 30th of September 2021. So the interim audit is meant to look at your internal control systems, do your risk assessment, look at get management representation. Then they audit the first 9 months. When they audit the first 9 months, they come up with an interim management letter. That interim management letter shows the weaknesses, the deficiencies in your internal control system, right? Now, doing this interim audit, they have covered a huge chunk of the audit. They have done 9 months. So when they come back on the final audit, that final audit starts on the 15th of January. Now, it will majorly focus on 1st of October to 31st of December. Then they will do a recap of the whole. They will look at now the whole year, but not really doing much because they did a lot in the interim audit. So the final audit is where the report will be drafted, the final analytical procedures will be done, then the audit opinion issued. Now, when they do the audit, they'll do it for like 4 weeks, field work. Then by 28th of February, they've come up with draft financial statements. Now, those draft financial statements, we discuss them around 5th of March. That is management and the auditors, make any corrections that need to be made, any adjustments, discuss the management later, put in our comments as management. Then on the 15th of March, the accounts are presented to the audit committee of the board. When the audit committee looks at these accounts and they're happy, the auditor has to present those accounts to the audit committee. They attend the audit committee. When they present those accounts, any material misstatements, management has refused to adjust these accounts, then we also adjust material misstatements. We give our reasons as to why. Then if the audit committee is satisfied with these accounts, they will approve them. Rather, they will recommend them for approval on the main board. For our case, the main board does not sit on the same date as the audit committee. The main board normally sits after 2 days. So on the 18th of March, the main board will approve these accounts. When they approve the accounts, then the auditor will go back and draw up the final audit report and the final accounts. Then by 31st of December of March, we are filing them with the audit with the Insurance Regulatory Authority. Helen Akisa, does that sort you out? Okay. So again, understanding your client, there are no changes in the financial reporting standards, laws, and regulations that will require a change in accounting policy. So you have not noticed any changes in the accounting policy of Templar. Okay, you've understood your client. Now, you go to the extent of setting your materiality. Materiality will initially be set at 0.5 and 1% of revenue. So these guys chose a benchmark of revenue, okay? Meaning that anything below 0.5 is material, and from 0.5 to 1 will be either material or immaterial. Then anything above 1.5 will be, rather 1 will be material, okay? You give your reason as to why you are choosing to use revenue. Revenue, you're considering it to be more accurate than the profit before tax, okay? Here, you materiality at, excuse me. Okay, sorry about that. Okay, so we are, so I'm saying that the materiality for any items of the financial statements will be set at the net asset value. Okay? So now, areas with high risk of material misstatement. When you look at the financial statements, you see revenue increased by 12%, but the cost of sales increased by 19%. So there's a risk that cost of sales have been overstated. Now, you see revenues increased by 12%, but the cost of sales increased by 19%. Now, there's something that is missing here. There's a comparative for the previous year. Something is missing, but okay, for your learning purposes, is that when you compare the previous year with the current year, you find that revenue increased by 12%, but the cost of sales increased by 19%. I don't know, Glonius, is it Glonius or Profit, whatever? Can you please mute your mic? Okay. So here, when you do your analytical procedures and you find that the revenue increased by 12%, but also cost of sales increased by 19%, ideally, they should move in line. Okay? When revenue increases by 12%, the highest cost of sales can increase by would be maybe 13%, right? But the cost of sales are increasing by 19%, meaning that there's a risk of cost of sales being overstated. Then we look at inventory in the statement of financial position has significantly reduced compared to the previous year. Again, if we don't have this, but ideally, when the revenue significantly reduces, not in line with rather when the inventory significantly reduces, not in line with the revenue, then there's a possibility of valuation errors, right, of revenue. And this is made worse given that there is a change in from a manual accounting system to a computerized accounting system. There's a possibility that either when they were migrating the revenue counts or the revenue figures from the manual to the computerized system, there's a possibility that something was left out, okay? Yeah. Receivables have increased by 50%, significantly more than revenue. Now, this is a very big problem. Your receivables should move in line with the increase in revenue. But if they increase by 50% more than the increase in revenue, that means that you are selling a lot on credit and you are not collecting. You're not collecting. And now, if you're not collecting, the right thing that you should do as an auditor is look at the aging analysis. The aging analysis to see how old these debts are. If these debts are as old as 365 days, then they should be provided for. Are we together? But the provision for bad debts is also heavily dependent on the accounting policy of the client. Okay? If the client says that we provide for any debts that are as old as 180 days, so you expect anything older than 180 days to be fully provided for. Okay? So that is a risk area. Receivables are risky, inventory is risky, cost of sales are also risky. There's a risk of material misstatement. Okay? Then the non-current assets have fallen by 90 million, which is significant given that most non-current assets land and buildings. So if the non-current assets fall to that extent, that means that there was a sale. But remember, we saw that one director bought a motor vehicle. So you have to ask yourself, what was the reason for selling off this motor vehicle? Were they selling it off because they were probably they wanted to pay off liabilities, or there must be a justification for selling off the non-current asset? Now, when your receivables are falling, Bonita, when your receivables are increasing at a rate higher than the increase in your sales, because you will only get receivables when you sell on credit, right? But if your sales are growing by 12%, but your receivables are growing by 50%, yeah, are increasing by 50%, then that means that you have debt collection problems. And it also signifies that there are debts from the previous year that you have not probably collected. Now, as an auditor, you have to look at what we call the aging analysis, okay? To look out for any old debts. But for you to ascertain that these debts are old, based on that these debts are old and they require to be provided for, you have to base on the credit policy of the client. When do they fully provide for bad debts? Is it after 90 days, 180? We normally classify them in 30 days, 90 days, 180, then 365 days. Okay. Some companies say we fully provide for bad debts that are as old as 365 days. Others will be like 180, others will be like 90. Okay. Yeah. So there's a risk that you have debt collection problems. I don't know whether I've answered your question, Bonita. Okay. So what will be your approach? What will be your approach? Your approach will be to test compliancy, like are they complying with the tests of controls? Okay. However, changes have been made to the inventory system, limiting the extent of compliance testing. Now, here the compliancy will be in terms of the revenue recognition, right? But because there is a change in the inventory system from manual to computerized, then you may not, because now you can't test the compliancy based on manual. You can only test compliance based on the computerized system. But there's a key risk regarding the computerized system that you need to look out for. You need to look out for how the inventory was moved from the manual system to the computerized system. There's going to be a lot of focus. Your audit should place a lot of focus on the migration of data from the manual system of inventory to the computerized system, because there's a possibility of omission and commission. Actually, management can use that opportunity to misstate cost of sales. That is why you can see there's a pointer that the cost of sales reduced significantly compared to the increase in revenue. It might be that there is an understatement as a result of migrating the inventory data from manual to computerized. Okay. So, of course, you take these actions, you like audit the initial installation of the system. How is the system installed? Okay. Yeah, this is what I was talking about, possibility of omission. Then test count inventory at the end of the year. Now you perform inventory counts and you compare it with the computerized inventory records. Okay. Manually attend a count of inventory. For example, you can say, let me count sugar. No, this is trucks. Okay. You can say, maybe let me count Sino trucks, and I count Scanias. I count maybe their spare parts, and I confirm if there are 100 Sino trucks physically, what does the computerized system have? If it has 98 Sino trucks, then that means that they are understating inventory, things like that. And when they understate the closing inventory, it means they are understating cost of sales. Okay. Test check bookings into and out of the system. Now, this is you're looking at when purchases are made. How are these purchases recorded in the system? That is what you're trying to check. Now, when sales are made, how are they issued out of the system? Like I said, a lot of emphasis is to be placed on inventory, because these guys are in the business of buying and selling trucks. So they keep trucks as their inventory. Okay. I hope you guys can hear me properly. Is anyone having a challenge hearing what I'm saying? Okay. Because maybe it's having issues. So the key areas are, you guys need to check your network, because the rest are hearing me. The key areas of risk are inventory, receivables, cost of sales, and some non-current assets, okay? So other risk areas can be like, you look at the client. Does the client appear to be a going concern? Yes, the client is a going concern, even if there's a drop in gross profit. Cash and profit forecast for the next 12 months must also be obtained to confirm continuous profitability. Like you see, if the company is profitable now, whereas there's a drop in gross profit, we always prepare what to call forecasts, okay? Is management forecasting to make more profits, or is management forecasting that there's a drop in cash? If management says that they will continue having cash flow challenges, then there's a slight risk, okay? We talked about the related party transactions where a director purchased a motor vehicle. Was it at arm's length, or do you need to look into it more further? Will there be any assistance needed in respect to stock take? Because there are 3 stores that are far away from your offices. Would you need to get another person to do some stock take, or would you rely on work done by an auditor? So ladies and gentlemen, it's very, very important, one, to understand your client, look out for the risk areas, to appreciate the industry they are operating in, and then to understand your audit team. That is when you can come up with an audit strategy. Okay? Yeah, so this is just what is involved in an audit plan, like we discussed previously. Now, guys, can you behave? Who are these guys? Who are these people? Are you in a market? Where are these Zoom user? Okay, so I wanted us to look at an example of an audit timetable. And here they are saying big entity, in January. Hello? Yes,
They are
Nelly?
listening, sir.
You're listening? Okay. So this is an example of an audit timetable. In January, now you're planning, January to March. Now that you're planning now the audit for 2021, okay? January to March, you're doing audit planning, yeah? Where you look at the risk assessment, you document the client's internal control system, you check whether it is effective, then you develop an audit strategy, okay? That is Jan to March. Then in October, like I told you, in October, you do an interim audit, In October, you do an interim audit that covers the first 9 months, which is 1st of January to 30th of September. You test the controls, the internal controls, and you do some substantive procedures for the first 9 months. Then you issue an interim management letter. You know what a management letter is? It is drafted by the auditors to management, showing deficiencies in the internal control system. Now, normally, I don't want this. Normally, the audit starts in January, the next year. January 2022, now you're performing the final audit, right? You perform the substantive tests and analytical procedures like we have been doing. Then you prepare the audit report for the directors to sign. Then you issue the final management letter, okay? That is it. Are you together?
Excuse me, sir.
Yeah.
Excuse me, sir.
Yes, Stella.
Excuse me, sir. Scroll a little bit. want to scroll a
What?
little bit back behind. There is scroll a little bit behind, like back before the
I where? Stella,
yes,
where do you want me to go?
before interim audit,
Before interim audit. That is
before the
January to
October
March.
2021. There is that first, yeah,
Before October. Here,
January 20. Okay.
January to March 2021. Is there a challenge, Stella?
Excuse me, sir.
Yes.
I also didn't get at this point of substantive procedures on transactions and account balances. I didn't get the meaning.
For the first 9 months.
No, substantive procedures on transactions and account balances.
Now,
Yeah.
unfortunately, we have a lumpen with us. I don't know who this Zoom user is. He must be in the village. No urban migration. So you had a question. Can you please ask again your question,
Yeah.
sir?
I didn't get that point of substantive procedures on transactions and account balances for the first 9 months. What did you? Yeah.
Now, given it's an interim audit, like I said, you look at 1st of January to 30th of September. Let's say you are going to audit cash, cash at bank. Now you do the substantive procedures, for example, reperformance of bank reconciliation, okay? Looking at the records pertaining the banks, okay? Are you getting me?
Yeah, I'm getting you, sir.
Yeah, you dig deep, you like do a full audit on these account balances in respect to the 9 months. Like, for example, non-current assets, you test for their existence, you inspect the documents, you do some inquiries, you get?
I get you, sir.
Yeah.
Sir, excuse me, it means an interim
Yes.
audit is done audit before the period end.
Pardon?
An interim audit, in short, is an audit before period end. Is it
Yeah,
what you
before
mean?
period end.
Okay.
Yeah. And but that's where most of the work is done, Edwin.
Okay.
Yeah. Any other question?
In brief, is a preparatory audit.
Yeah, it's a preparatory audit.
Brief,
And
it's a quarterly audit, like we decide on how many months are we going to audit, and we put focus on what we've covered, on what the company has covered so far. If let's say if they have covered, if we agreed that we are going to audit 3 months, then we start auditing, we dig deep in 3 months so that we cover the next 3 months, the other month after. But we give them a management letter showing the weakness and what they have done good and where they have to add more efforts and what's not.
Yeah, true. And ideally, the management of the business must put into consideration those recommendations, and they always also give their comments on the issues raised by the auditor. Okay.
But I think I should, if I may ask, do we have to call for suppose it's called an annual general meeting?
Yes.
Sorry, now I have the answer, because I thought every after an audit they have to call for a meeting. So here they don't need to call for any meeting because it's a quarterly audit.
Yeah. Now here you see it's for example, if your accounting period starts on 1st of January and ends on 31st of December, looking at everything in January 2022, you will say that, okay, in October, we are going to do and look at the first 9 months, right? That is Jan to September. We are going to do tests of controls to see how the internal controls are. Then we shall perform some substantive procedures on a couple of account balances and transactions, right? Thereafter, we shall have gathered enough evidence and we shall issue an interim management letter showing the deficiencies. Are we together? So meaning that now when we come back in January 2022, we shall be looking at the 3 months, which is October, November, and December. Then we eventually wrap up to conclude the whole audit.
So, sir,
You
if
get
I may ask,
why they do that is to avoid panic, eh?
yeah,
Avoid panic because you need to meet deadlines.
if I may ask, for the quarterly audit or an interim audit, we just give them the email only. Don't give them a report.
Yeah, you give an email only. The report is given on the final audit.
Oh, so here we give them an email showing where they have to put in an effort and whatnot. Then we start writing.
Yes.
We start writing on the management report already. Is that so?
Yeah, you write the management. No, you write the management data. The report, the audit report is there is a template that they use, eh? But the most important thing is that you have your working papers. Okay, for everything you do, you have your working papers because there will be a basis of your audit opinion. Is someone not seeing my screen? Are all of you seeing my screen?
Yes, sir.
Yeah, we are seeing your screen.
Sylvia, I think you may need to refresh. Check your settings. Yeah.
Sir.
Now, let us look at yes. Any questions? Okay. So the budget. Now, like I said, our audit is paid based on times, hours, okay? The money they give an associate is not the same money they'll give a senior associate, a manager, a director, or a partner. You can see, as you can see, guys. So now for you can see where you fall. For you, your hour is paid 70K. So a senior associate 100, manager 500, director 600, partner, and you see that the most time is spent by the associates because they do the field work. You get what I'm saying? So you see associate 1, 2, 1 and 2, you see in between them they have like 320 hours. Senior associate has 90 hours. The manager has 30 hours. The partners, and directors have those 10 hours, right? So because most of the work is done in the field work.
And
Guys,
those from the field are paid much lesser.
Yes, because you don't have the necessary, you're doing whatever you're doing does not really require a lot. The higher you go, the more money you get, though it becomes cooler. Eh?
You have seen where you fall.
Yeah, but all of us have been there. That's where you start, and then you eventually go to the partner, to the level of a partner. Okay. So now I'll take you to like a program. An audit program basically shows the procedures, that is now the work you're going to do. And what assertion are you trying to confirm? Assertion is like what management is saying is happening. Then done by who? Then the working paper reference, okay? So the audit program is for sales, working paper reference that prepared by so and so, prepared by the audit manager, rather audit senior, reviewed by the audit manager. Date the client is, let's say ABC Limited for this period, okay? So now these are the audit procedures. I won't go so much into them because you're going to do them when you're studying audit of financial statements. So like you say, you can carry out a sequence test for goods dispatch notes. I'll give you an example. When you have dispatch notes, they have to be in a chronological order. You cannot have dispatch note 1, then you eventually go to 10. No, they are supposed to be in what? In order. Even the invoices are supposed to be in order. So you trace those invoices. For example, you can trace a sales invoice to a sales journal to check out whether it's accurate, whether the discounts are computed accurately, whether the customer name is the one that you have in the aging listing, the product documentation, whether the product description. When they say you sold 10 items at 100,000 each, you do a computation. Is it giving you 1 million shillings? Okay. So it basically shows the procedures you're going to perform in respect to a particular audit program called sales. There will be an audit program for non-current assets. There will be an audit program for cash.
Excuse
There will
me,
be an...
sir.
Yes?
Excuse me, sir.
Yes, madam. I'm listening.
Excuse me, sir. Now you have
Yes.
said like in order. Does it mean according to the years?
No.
I'd like
seen...
to know the way.
Stella,
Yeah,
have you
the way
ever
it's
seen
in order.
Serial
Like this
numbers.
audit
Stella,
thing is done in order.
Stella, have you ever seen an invoice? Stella? Hello?
Hold on. Yes?
Have you ever seen an invoice, Stella?
Yeah, ever.
Have you ever seen a serial number on an invoice? Like they will say an invoice.
Yes, I've
immediately.
ever seen.
Now, for dispatches.
Yeah, I'm hearing you. I've ever seen it.
Okay. How about a dispatch note?
Yes, I've ever.
You've seen a dispatch note, eh? So when you look at that dispatch note, it also has a serial number.
Serial number.
Yeah, they always have numbers, dispatch numbers or notes. Eh? They will have numbers like 1, 2, 3, 4. Eh?
No, I've ever seen an invoice.
How about a delivery note?
Invoice.
How about a delivery note?
Okay.
Yeah.
Yeah, yeah. Now they always have those serial numbers.
I've ever seen it.
Yeah, they always have those serial numbers, and they must be followed. Okay, that is good. Now they always have those serial numbers, and you cannot say that when you issue a dispatch for 01, you skip 2, 3, 4, and you go to 10. No, they have to follow that order, that sequence. Okay. Any other question? Now, guys, I think we are done with we are done here. I just wanted to show you an example of working paper. Ruth Nisima. Ruth, can you mute your mic? Thank you. Yes, sir. No, Nelly. They are not assumed figures. These forecasts are done by management. For example, Nelly, if for example, we have covered This is a good example. We have covered January to June, right? And those are 6 months. Now, when you're doing a budget, you do a budget for 12 months. For example, we did a budget for 12 months, and we said that by the end of the 12 months, we shall have recorded profits, rather revenue of 12 billion. Are you with me, Nelly? But Jan to June, we have done 3 billion. So meaning that we are off. Okay, Jan to June, we have done 3 billion, meaning we are off. Because if you budgeted 12 billion, that means by half year, you should at least be by 6 billion, right? But by half year, you have done 3 billion. Now,
But
as management, we go back to the drawing board and we say, okay, this is what has happened in the 6 months. Are we still comfortable with the budget from July to December? We say no, we are not comfortable. Things have changed. The economy is so poor. Fuel is high compared to what we expected. So now you advise our users that in from July to December, this is what we are going to do. So you're forecasting your performance. Are we together? It is management that forecasts performance, Nelly. And the forecast is done based on what is happening now. You get? Okay. So this is a working paper, ladies and gentlemen. It's basically showing the same thing. What are you trying to do? You're auditing inventory. What audit objective do you want to achieve? You want to test accuracy of the year-end inventory. So to test accuracy of the year-end inventory, what are you going to do? Work done. You're going to select a sample, then you're going to look at the dispatch notes. Source of information will be the dispatch notes, and the key to any audit risks, appropriate cross-checking. What results have you found? Weaknesses in the internal control system have been detected. Your conclusion, the financial statements, the area would make financial statements show a true and fair view, okay? Yeah, Sylvia, it's your network that is poor. I don't think it's my network. Yeah?
Excuse me, sir.
Yes.
I think we use different substantive.
You think what?
For sale.
Guys, your network is poor. Huh?
No, so I use different substantive procedures for inventory and sales.
Different substantive procedures for?
I think we use different substantive procedures for testing inventory and sales.
Yes, they are. You use different, but sometimes they can, especially for inventory and purchases, they may cross-cut.
When testing inventory count, yeah, they can
no, it's not
sometimes.
only inventory count. It's not only inventory count, though it is the major procedure. So when you study audit of financial statements, you see the other procedures, but it's not only inventory count, only that it is the major one. For example, another audit procedure you do is to ascertain whether the client diligently followed IS2, which is looking at inventory at the lower of cost or net realizable value. Okay, there are quite a number of procedures, but as you must note that these procedures change depending on the area that you're auditing, the account balance you're auditing, or the transaction you're auditing. However, they cross-cut. Some of them may cross-cut, okay? But you get more about this when you're doing audit of financial statements. Okay? Now we covered this in a summarized form. Now, guys, any questions?
Good evening, sir.
Good evening, Mansoor.
Yes, I have a quick one.
Okay.
Earlier on, we were introduced to some of the threats to the principles of auditing, and we've encountered a certain situation, and I wanted to bring it to your attention and get your advice on it.
Okay,
when
that's good.
an auditor audits your financials, and then they give you a report based on those audited statements,
yes.
Upon which URA is able to give an assessment. Now, after some time, URA feels like they are not content with the assessment or the return that you have filed. Now, later on, they ask you to get someone to sort of defend the assessment. Is it in order? Is it, are you not contravening the ethical principles if you get the same auditor to go and represent you or to try and defend their report? Because it's the report that you based on to file, returns upon which you are made an assessment. Would that as well be seen as an advocacy threat, like we were earlier introduced to?
Yes.
Self-interest is self-review threat.
Yeah, advocacy. You see, in practice, what we are seeing is that the audit firm, audit is separated into assurance and consultancy, right? Now tax falls in consultancy, audit falls in assurance, right? The auditor is not responsible for your tax numbers. Are you getting it? The auditor is not responsible for your tax numbers. What happens is
what I got, Mansoor made, if I audited the company and then you are based on my report to do the assessment. So is it okay for me to go and I explain my report as like how auditors, we go and we explain our report to the AGM, to the members? I think that's what Mansoor made. Like, is it okay if I've made a report for MOOBs, then is it okay for me to defend my report, to explain it to URA that this is what they made and this?
No, it's the tax consultant, not the auditor. Are you getting it, Mansoor? Though you find that some people may use the same audit firm providing, again, tax consultancy. You get? Because there was a time, for example, we had one audit firm doing the assurance and also doing tax consultancy. You get? So now if you're going to URA, it is not your audit, it's not the audit, the ones who did assurance, but it is the ones who did the tax consultancy that can sort you out, that can go and back you up with URA. Are you getting what I'm saying? Mansoor, are you getting what I'm saying?
Yes, sir. I get it.
Okay,
Only
sir,
that now, from these particular auditors, what they, okay, because now the simple, just a simple picture of what happened is they audited your financials, but then filed an assessment, rather returns, URA does an assessment. They later find out that in the assessment or in the returns you filed, they are seeing money because maybe the parent had loaned the money to the subsidiary. They find out that, okay, of course, now you're reporting losses and they're not able to file, you have no tax liability at that moment. But they do not feel content because of the constant remittances that the subsidiary is making to the parent in that particular regard. So they feel like, no, we are not content. So kindly come and sort of defend this particular assessment. Then management feels they should go back to the same audit firm, okay, and ask them to come and from their understanding, they feel like you've done this work. If you're sure of what you did, come help us and defend. Then this audit firm tells them, okay, let us do about 800 USD if you want me to come and defend your, So that's what I thought about. Could it as well be seen as an advocacy? Because here, as an audit firm, you're going to try and represent whatever is in the best interests of the client. But then you're the same person that had audited their financials upon which they filed a return.
Yes. Now,
but
Mansoor, I want you to look at the people who you're going to pay the 800. I'm very sure it won't be the audit firm. For example, if you have PwC Assurance, yeah, those are the guys who did your audit. You get it? So when you encounter them, and say, we need you guys to go defend, I'm very sure they're not the ones who did your tax numbers. Are they the ones who did your tax numbers?
Sir, if I may add on Mansoor's issue. Imagine we are auditing a farm. Let me use an example of circles. Since they are exempt from tax, but they'll pay tax in 2027. But for now, we are the ones filing their reports, filing their returns because they are not paying taxes. So we may at some time be putting zeros or something. So at some time in 2027, URA comes and says, you guys have been filing zeros and you've not been putting your minds on this. So we want someone who has been doing this to come back and explain what they were doing, what they meant by this. You get? I think that's what Mansoor is trying to mean.
Yes.
Since they are exempt from taxes, then we've been filing. Every time we go to do an audit, we file for them. Since nobody's going to keep track on them. Then when time comes.
No, the auditor cannot file for you returns. Martin and Mansoor.
Hello?
Your auditor can't file for you returns.
Excuse me, sir.
Yes.
But in Uganda, it's very possible.
Sir,
I raised the question. Just a minute. So I raised the question and you gave me the advice I needed. And to me, that is clear. I also understand the auditor cannot file your financials because that is not their work. Me, for that particular case, I was so in the clear. What I wanted was to understand whether it wouldn't be seen as an advocacy threat to the ethical principles of auditing, which you made so clear, and I'm so good. Thank you so much.
Now let me guys tell you, and this is what you need to advise your people, your at your workplaces. It is always important to have a tax consultant, but that tax consultant can't be your auditor. You get it? That tax consultant can't be your auditor, but your audit firm like PwC has a consultancy arm that does tax consultancy, that they will compute your numbers, because there are some businesses, some companies that are so big that you can't compute your own tax numbers. You have to get a tax consultant. But where for example, like an example of advocacy, where for example you are the auditor and you're fronting your client for a loan, that will be advocacy. Now we have problems. Who is this Bolt?
What about in the scenario where I was their consultant, where I was their consultant before taking. in the scenario where I was there consulting, where they used to consult from me before I won the tender to be their auditor.
I'm losing you there, someone. This bold person, eh?
I'm asking in the scenario where, because some audit firms, at some time we may be providing the consultancy services as well, right? So in the
Martin,
yes?
kindly repeat, because I wasn't hearing anything. We are being disturbed by this bold person. I don't know.
I'm saying in the scenario where I was their consultant at first before we the tender be their consultant, not their auditor. After doing the report, I put that aside. Then I come. I delegate someone to be there.
For me, I'm seeing
Martin,
several threats there.
Martin, there are a lot of threats there. Have you heard of what they call a Chinese wall?
Yeah, I've heard, but in Uganda, I've seen this happen before in Uganda.
It happens. It's true, it happens.
In Uganda, I've seen many things
They are
against
teaching
audit.
you what to
Many
apply,
things.
not a
It
Ugandan
happens.
way.
It happens, Martin.
That's why you come to the physical part. You come to the practical part. You get to.
Martin, it happens, but especially when you're using small audit firms, it will happen. But for example, in the big audit firms, there's always a Chinese wall that the consultancy arm of the business is not so linked to the assurance arm of the business.
Sir, I also think that at the moment, in such a situation of conflicting is a conflicting situation, I think this is where ethics has to come and be applied.
Yes, and where you say, you know what, guys, I cannot do both of these assignments. Let me just do one of the two. Okay. Okay. So guys, I think that is it. That is it about topic 3. It was nice meeting you. I shared the notes with Nelly. Nelly has this handout. It is the detailed version of even the audit documentation that we covered.
Thank you so much for watching. Make sure you subscribe to the channel.